You're listening to the Goldnomics podcast, with new episodes every month on iTunes and YouTube. Subscribe today to stay informed.
Welcome to episode 2 of the Goldnomics podcast, where we look at the developments in financial markets through the lens of precious metals. And before we start today, I just want to remind all our listeners to subscribe to the Goldnomics podcast on iTunes, YouTube, or SoundCloud. And you can also stay up to date with all of the developments in precious metals markets by subscribing for our market updates at GoldCore.com. And you can find a link in the show notes accompanying this podcast. And today we're asking the question, is this the greatest stock market bubble in history? And as usual, I'm joined here today by the dynamic duo behind GoldCore, Stephen Flood, CEO.
Hello, everybody.
And Mark O'Byrne, Director of Research and well-known precious metals commentator.
Hello, podcast listeners.
Now, last month we talked about the major themes for 2018, and one of the phrases that came out of that, and Mark, I think it was you that said it, is the idea of the everything bubble bursting. And that's the idea that we're seeing concurrent bubbles in stocks, bonds, property markets, cryptocurrencies, which is quite an unusual phenomenon for financial markets, where nearly all asset classes are trending significantly higher. But at the same time, markets seem to be complacent. Volatility is low. They keep trending higher. We've low interest rates. We've low inflation. Unemployment numbers are good. We've seen big tax cuts in the US. Why are we going against the flow and calling this a bubble? Steve?
Yeah, it's we're in what's been termed a kind of a Goldilocks economy, where a lot of the underlying economic statistics are very supportive of the market and growth and confidence. No matter where you look, it's looking very, very positive. But if you look at from the trough to our current peak, you know, the S&P 500 has put in an incredible return of, I think it's estimated about 270%. And, even in any historical analysis, that is an incredible return. I think I don't know if we're at the peak of the bubble but I do know that we're in the bubble cycle, because you can see it in the dialogue and the narrative in the market. There's an awful lot of people who are, getting into the market on the basis of fear of missing out. And I think that's a part of a bubble cycle. And you're also seeing it in the media as well. And you're also getting some, you know, a lot of people talking about, you know, this time it's different. You know, we have a massive tax stimulus package in the US, and therefore the fundamentals are different now, and therefore we can justify higher valuations. And I think that's all part of historical bubbles. You see this narrative play through every other bubble in the past. So I think 2018 we're looking at a year where you're going to see probably increased stock market highs, and it might blow off into a parabolic move before it gaps down. And it's not a healthy thing. You know, people need to invest in the long term, and I think we're going to discuss that in this podcast.
Mark, why are we going against the trend here and calling this a bubble?
I think the smart money is again, and many of the same people who warned about the first financial crisis are warning about this next coming financial crisis. And there's just so many indications that we are in a bubble. And the question is, I suppose, what stage of the bubble are we in? Is it this early, middle, or late stages, you know, because these bubbles can go on much longer than people anticipate. And sometimes people can be quite early in calling these things bubbles, and the bubbles don't actually burst. It can take a long time because momentum is a powerful thing. So, I mean, I think we all view it as a bubble, and the question is where we are and how the bubble may burst. Everything bubble may burst. But when it comes to stocks, the US stocks in particular have had a massive price appreciation. So if you just look purely in terms of price alone, I mean, we're up, 3 times. I think from 2009, the S&P is up over 270% from below 1,000 in 2009 up to 2,700 today. Last year alone, the S&P was up more than 20. And just in the first 2 weeks of 2018, it's up another more than 5% in less than 2 weeks. So, if you look at the returns of stock markets over the long term, 50, 100 years, they tend to return 7 or 8% per annum. And we're up 5% in 2 weeks, So, and we can get into, I think about myself and Stephen have looked obviously in terms of the various figures that are there in terms of the technicals.
But it's been a sustained run as well. I mean, like the S&P, and they're looking at something recently, and it's saying that the S&P hasn't had a 3% pullback since November 2016.
Yeah.
Which is phenomenal. Yeah. And one that I keep an eye on, and I think most people will be familiar with, is the Dow Jones average in the US. And, that's up 30% in a year. I mean, is that warranted? I mean, what's underpinning a 30% rise in the Dow in 1 year?
But I don't think it is warranted, Jen. It's due a very serious correction and potentially a crash. I mean, it's gone up 1,000 points alone just in I think in 7 or 8 days, from 25,000 to 26,000. And President Trump, the president of America, is calling for Dow 30,000, and he's trying to take credit for it.
Right.
And we'll get into this now. All the warning signals are there, but the way to evaluate a bubble is actually four ways to do it. Rising prices without improving fundamentals. And I think we have that. The fundamentals are fairly good, but there's a lot of superficially very good. If you look underneath the bonnet, so to speak, it's quite rusty and they're on shaky ground, and we'll get into that. The next thing is leverage. When you've got people using a huge amount of debt to buy assets, that's a factor that you need to keep an eye on. Political and monetary interventions. So we've seen that in spades. Obviously, central banks have decreased interest rates to 0% and engaged in quantitative easing. That's what's contributed in a huge way. And then the fourth thing is actually sentiment. And we have irrational exuberance in spades today. And that term irrational exuberance, I think it captures the moment of where we're at. And that's what Greenspan said in 1996. And the Dow Jones was at 6,000 then. And he was suggesting it was a bubble then, and subsequently went well above 10,000, and it didn't burst till 4 years later. So, who knows, this bubble that we're in, it could go another 2, 3, 4 years,
There was some research note there recently from one of the major investment banks calling it rational exuberance as opposed to the irrational,
right.
On the basis that they think it is historically very, very high, but it had a ways to run, and they saw maybe another 10% move this year.
And what do they see is kind of fundamentally underpinning that?
God knows. I mean, like it's. I suppose they're on the sell side, so they're always going to talk it up, and you have that bias inherently there. I think they're looking at the debt markets, and they're looking at the overall consumer confidence, and the manufacturing indexes are being very supportive. Housing market is very supportive as well, and there's a number of positive kind of economic indicators that are leading to that Goldilocks economy. So we're not seeing the stresses yet. I think we're going to see stresses coming out. We're going to see some money coming off the table. One of the major things I've looked at before is the unemployment rate in the US. It's at 4.1%, and every time, I think I mentioned this last time, every time it hits that point, it tends to be a point of contraction, and the market then sells off as assets come off the table. You're at full employment, and then you start having inefficiencies coming into the market, and people begin to divest.
But just one thing on that Goldilocks economy, that 4% unemployment rate it's quite bogus actually, because if you look at the methodology of how they calculate the unemployment figures today, they've changed radically compared to how they calculated those unemployment figures 20 or 30 years ago. There's been different incremental changes over the years in terms of the statisticians in the Bureau of Labour Statistics, and a number that I look at is the food stamps number, and 15%.
Food stamps number. So what's that? That's the number of people actually signing on for food stamps.
Exactly, to feed themselves. Right. In America, it's 15% of the population.
15%?
15% of the population. So what they're calculating is people, you actually fall off the statisticians' numbers in terms of unemployment. They have all these statistical gimmickries whereby you actually fall out of the numbers after 12 months, because they assume that they may say that you've gone and created a business, or you've given up looking on work, or you're not actively trying to find work. So they actually take out a number, but so they're actually not factoring.
So they're losing out, not accounting for long-term unemployed.
Exactly. That the 4.1% does not account for.
So 4.1% is only really a number that suggests or underpins short-term unemployment.
Exactly, yeah. And there's a great guy, we've covered him on many occasions, John Williams in Shadowstats, who looks at a lot of these statistics and he shows how they're manipulated in effect, So it's creating the impression of a Goldilocks economy. But as I said, when you look underneath, Goldilocks is, she's not as pretty as you would think, shall we say.
And obviously the Goldilocks reference there when it comes to the economy is not too hot, not too cold.
Yeah.
Just right.
Just perfect, exactly. Yeah,
just perfect.
Yeah.
Right. And, when talking about unemployment numbers, I mean, I was reading something, you covered him, Stockman, in the Market Update yesterday. It was a very interesting article, but I was reading something that he wrote something in the Wall Street Journal, and he was looking at various figures, and he talked about manufacturing jobs, and that in the period of 2007 to 2010, there were 2.3 million manufacturing jobs lost in the US. And in the period of 2014 to 2017, only about 10% of those jobs lost have come back on stream.
They're losing the better paid jobs as well. And so you're getting a lot of casual labor and part-time work and, McDonald's jobs, low paid jobs. This is part-time jobs. The quality of jobs is going down as well, and that means the wages that people are getting for those jobs are not going up, and that would be the sign of a true Goldilocks economy. People would feel the wealth effect. The man on the street would feel wealthy, but the man on the street is not happy, is not angry, and you see that in Trump being elected and in the move. We covered this in the last podcast in terms of the move to the left and right and the more extremes that we're seeing. People don't feel wealthy at all, and the rich are benefiting from the quantitative easing and the 0% interest rates because they own assets, whereas the man on the street doesn't tend to own assets, and they're dependent on their wage, and they're not seeing any increase in their wages.
Steve, last time
and more job insecurity, in a huge way.
Yeah. Sorry, Steve. Last time you talked about this wall of liquidity looking for a home, and you talked about that in relation to basically the everything bubble. For those that may not have listened to episode 1, can you just kind of give us a refresher on that and tell us how it's fueling this stock market rise?
I mean, in the leading up to the last financial collapse, there was an awful lot of excess in the broader capital markets where a lot of debt was taken on in an unsustainable format and way. And obviously when the asset prices started to correct and the debt was found to be completely unsupportable, the official sector stepped in and, on the basis of trying to, cure the market, they tried to cut out the cancerous debt overhang. And what they did was they took all that debt in and hid it away from the market and put it on an off-balance sheet vehicles controlled by the central banks. And they paid back out on this debt 100 cents on the dollar. So they reinvigorated the market. They gave it fresh capital and fresh cash. And they said, lads, let's learn our lessons. Let's have safer banks. Let's put in new regulations. But here's your money back. And here's, let's hit the reset button and go again. And so an awful lot of this cash.
So that would be, sorry, just to kind of to clarify that, that's going to be, an institution would have bought a bond originally, say, for $100. And that bond has fallen in value down to 90, 80, 70, 60, or even lower.
Yeah.
And then the central bank is stepping back in and saying, I'll buy that back off you
at 100.
At 100.
Yeah, yeah. So they basically allowed the banks to earn back the original face value of that debt, in the interest of recapitalizing the banks and injecting capital, much needed capital, back into our economies.
Because if they didn't do this, then subsequently you're going to be looking at bank collapses. They basically they had to do this.
Yeah, we're looking at a potential depression, which could have lasted for an awful long time and led to massive social problems right across the Western world. And so this was unpalatable. And so they decided to cure the market and cut out this cancerous debt. And they did this through quantitative easing. So they would expand their balance sheets. They would issue money out of nothing on one side of the balance sheet, and then they would sell it and take on liabilities on the other side, the debt. And they would give that cash. That cash would then make its way to those banks and those private equity firms. And they would go out and invest that money. And the theory being is that once they invest that money, then those companies do well, and the benefits of that will then wash down to the lower parts of the economy, to employment. There's more employment, more spending, more wage growth, and then the economy gets back, and it's kind of a virtuous circle. But really what's happened is that the higher echelons of society, the asset ownership class, they saw a massive appreciation of their assets. they saw their liabilities dwindling, and they paid back debt, and they own assets, and they rent those assets out, and they haven't necessarily been spending it in new capital projects. And so we haven't had a huge, capital boom that you would expect to see in an economic recovery. And you haven't seen the kind of the movement of money throughout the economy changing hands as you would expect to see in a recovering economy. In fact, after most recessions, you tend to see the velocity of money increasing as people become more confident and have more money in their pocket. But you haven't seen that at all. In fact, you've seen the velocity of money dropping to its lowest point in recent history. In fact, it's at 1.47 now. If you look at the stats, it's incredible. So by injecting all this money into the economy, it didn't trickle down. So the initial strategy didn't work. And what you're seeing is one part of the population benefiting from higher asset prices, and the other side of the economy not getting a wage increase and not getting extra money to spend, and more uncertainty as to their prospects.
And just on that, see if it's the nail on the head. And that's the fundamentals. He's really got into the fundamentals of the economy and where we are today. And the bottom line, when you look at that, the quantitative easing and what they did there, we had a credit crisis stroke debt crisis. I think it's better to look at it almost as a debt crisis, because it's the amount of debt in the world in 2007, 2008 at every strata of society contributed to the initial liquidity crisis and then the solvency crisis. But today, the debt has actually gone from, it was 150 trillion pre-crisis. Today, it's 233 trillion. So it's gone up over 80 trillion in less than 10 years in this so-called recovery, Wow. So, if you look at a chart, it's very interesting when you look, and that's the key thing, is the debt to GDP ratio. That's a key measurement of, of economic soundness and the fundamentals of the economy, and whether it is a Goldilocks or not, you know. Yeah. So Goldilocks is swimming in debt, and then she's going to be foreclosed on and put out of the house very soon. It should be very cold indeed. Picture paints 1,000 words, but it looks like when you look at the charts, you could always see that the GDP growth would outstrip the increase in the debt. It would always be slightly higher and increasing,
which suggests that you're getting a return.
Yeah, exactly. And recently, it's gone the other way, whereby the GDP is sort of over the top of a hill, and it's sort of plateauing, and it's increasing very, very slowly, if not topping out. Meanwhile, the GDP is going parabolic, And just in the last year alone, it's gone up 16 trillion from the start of Q1 2017 to the end of Q3 2017. So another 16 trillion in the debt, So it's clearly unsustainable, and that's why we believe we're in this everything bubble, and US stock markets in particular in a bubble. There's others. You have to look at a different stock market. Some markets are undervalued. Maybe there's a reason undervalued. Whether it be Syria or Venezuela or Russia, markets can be undervalued and they can stay undervalued. So, but the US market looks very, very overvalued indeed, and I think that's the key in terms of the fundamentals just driving it.
Two things on that. I can't remember what it was, but I remember a while ago we were talking, Mark, and you said, for every dollar of debt that's issued, the amount of economic return you're getting has now gone negative. I think it's like 60 or 70 cents. So, this is Ponzi scheme kind of territory.
Exactly. You're not getting a return on that debt.
It's actually costing you. Yeah. So it's costing the real economy. And you, if I have no problem with debt increasing as long as it has a purpose and a function. Like you're building factories, you're creating excellent products and services and efficiencies,
building capital,
building stuff. Yeah,
companies increasing the savings rate,
and bringing the population into productive work and activity. But what we're seeing now is kind of the financialization of our economies, where you have very creative financial products out there which are kind of creating a kind of a volatility in our daily lives that we're seeing in our house prices, we're seeing it in our healthcare, we're seeing it in our educational costs, and it's transmitting through the economy risks and shocks, and it shouldn't. We should have buffers in our economy that stop this happening. But one of the main points there is in terms of all this debt. Basically, you can look at the debt amount that's been produced by the central banks over the last years, and I think it's estimated around $20 trillion has been just magicked out of nowhere. And you chart that and you look at the actual stock markets, and it's one for one. Like literally every dollar of debt that the banks have produced has gone straight into stock markets. And that stock market growth really kind of benefits one sector of society, the top 5-10% of people. And the rest of them don't own stocks really. They're salary slaves. They go from, paycheck to paycheck. They don't have assets. They rent everything. And if they're lucky, they have some sort of stability in their job. Ever since 2000, the actual amount of individual prosperity that you can measure an economy for workers has actually plateaued. It's gone sideways, whereas corporate profitability has kept rising. And all of this comes down to the intervention of the official sector in the economy, trying to force the economy into what they want it to be successful for political reasons.
And so I just interrupt you there for a second, because we're being very much focused on US stock markets in the conversation so far. But just to say that this isn't just a US issue. This is happening globally.
Everything above it affects everybody. Yeah. But I think the US stock market looks more overvalued than others given the scale of the move up. I mean,
But in terms of the quantitative easing that we've seen, that's not isolated just in the US.
Of course not. No,
that's a global issue.
GDP and global. I mean, the global debt to GDP ratio is up near 320% now. And that's a ratio that would bankrupt most nations. So the world is in effect bankrupt, and we're talking about the Goldilocks, and she's massively indebted. Not only is she massively indebted, she's actually taken out loans to buy stocks, and this is contributing to the bubble. The margin debt is at all-time record highs, and I think you've looked at some of those figures, Steve, haven't you?
Yeah. If you look at margin debt, and margin debt is measured, and there's some great stats from the New York Stock Exchange. It's essentially the amount of debt that investors are taking out so they can participate in the marketplace. And at the beginning of last year, it was about 513 billion, which is a historical high. And by the end of the year, it's estimated around 580 billion. So massive growth just inside 12 months, and it's continuing to go higher. But even if you look at margin debt, inflation, that's not inflation adjusted, but if you inflation adjust it, then it might be lower. But if you look at it as a proportion of the actual the capitalization of the market, it's at an all-time high. I mean, I think the metrics coming in around 3% of the market is margin debt, and historically it was around 1%, 1.5%, and in the last financial crises, it was just under 1.5%, and now it's at 3%.
Whoa!
So it's double what was an incredible high the last time we had a collapse, and that just shows a huge fervor. It's very much part of the bubble cycle where people are fear of missing out. There's a huge, the media are talking it up, like they were talking it up in quarter four 2017, CNBC and all these guys. There was an awful lot of very positive commentary coming out of the markets, and Trump's economic stimulus and tax plans, and it's incredible to see, and we've been here before, but we just don't learn the lessons. And I think for our listeners, one of the most important things is to kind of acknowledge that this might be happening, and then to decide what can they do about it, and in order to prepare for it.
Yeah, absolutely. Just on the margin, I mean, this is higher than 1929. It's higher than 1987,
and that would have been one of the things from the 1929 point of view that was pinpointed as being the needle or the pin that burst the bubble.
Absolutely, yeah. And I read something, I don't have the exact figures to hand, but I read something recently that the move up in the Dow Jones Industrial Average from 1924 to 1929 is comparable to the move up that we've seen in recent years in the Dow Jones again. So there is a mini parabolic move going up, and anytime you see massive outsize outperformance like that, you tend to see a very sharp correction at the very least. But when you have this level of debt, not just in terms of the speculation using margin and stocks, but that's a big factor, and it's important to look at that, but just at every strata of society, that creates the real risk of a crash. And that's why I think, the thing to distinguish the US stock market is it's the biggest stock market in the world. And the so all the passive guys in the world who allocate in wealth management firms around the world and financial advisors, they would use the MSCI World Index as their sort of way to allocate the stocks.
Just a passive investor is somebody who buys all the stocks in an index, basically.
Exactly, a broadly balanced portfolio approach, and
doesn't pick stocks,
and doesn't buy and sell and time stocks, and doesn't pick individual stocks exactly, or individual sectors or geographies. So they buy the market in effect, and that's the way the MSCI World Index operates. But more than 50% of that index is actually US stocks. So if the US stock market has a very, very serious correction or a crash, it's going to impact pension funds around the world, and they're already under pressure very significantly because of record low yields on their bonds, and then the demographic time bomb that we've all been talking about for years. So there's a confluence of all these factors coming together, and we're only covering some of them,
Yeah.
But just to finish at that point, So it's this everything bubble as well. So that's in the background. Then you've got the problems in the bond market. And I do think that this is it's one of the biggest risks that we've seen in history, one of the greatest financial bubbles we've seen in history. And the question is, will it get bubblier in effect before it crashes and the air comes out? And then how does it crash? Do we get one more wave of deflation and a crash, and then the central banks print money again, and then we get massive inflation and hyperinflation, which is quite possible? Or do we go straight into quite an inflationary mode, which would see stock markets go even higher,
And I've just one question I want to ask you guys at this point. I mean, from a fundamental point of view, are people looking at the numbers coming out of these companies? How are these companies performing? I mean, is it
this is the nub of the issue. And this is, I think, where we differ from previous market cycles. We've gotten too smart for our own good, generally speaking. Since the development of exchange traded funds, or ETFs, which mimic certain sectors of the stock market, we've made it really easy for people to get exposure to certain sectors. And there's been a lot of study done on this recently. When I worked in New York years ago, we were developing ETFs on our desk at the time, and it was I think it was called the Treble Q at the time. It was for the Spider ETF for the S&P 500, and it went gangbusters at the door. People couldn't get enough of it because it was really, really easy, and it was cheaper than the alternative, which was active managers. And these were, paid stock market pickers who would go and try and beat the S&P 500 index. And people said, you know what, I'm happy just with the S&P 500 index, so I'm going to buy this exchange traded fund that mimics it. And ever since then, the percentage of trading of the US stock market that is it comes from passive indexers, we just spoke about, and ETFs has grown and grown and grown. And active managers, the guys who are stock picking, has fallen and fallen and fallen. And in fact, I think about 90% of trading in the 1990s was active. Now it's fallen to about 70%. And then ETFs and passive have gone from, I think it was about, 10 or 15% up to around 30%. They reckon about 10% of the market is discretionary traders, fundamental discretionary traders. These are people who are buying and selling, duking it out on the bid and offer in the market. And these are guys who are looking at the books. They're looking at the companies and they're saying,
they're doing a bit of price discovery.
They are trying to figure out, they're trying to price in that news. They're doing arbitrage strategies, long, short, whatever it is. And they are living with, on the basis of their capital going up or going down. And if it goes down, it hurts them. And that is a beautiful thing, because the wisdom of the crowd comes to bear. There's a price discovery mechanism there. And then the active guys would hang on, or the passive guys would hang on those pricings and would trade along with them. And so what we've had now is that if official sector is coming in as a bad actor, and I think I mentioned this before in the last podcast, and they're buying no matter what. The ETF guys are coming in and they're buying no matter what, because it's on a list of stocks in the S&P 500 or MSCI. And the passive guys are buying as well. And so the fundamental guys are being driven out of the market, and they're no longer participating. So the market is just going up and up and up. And they've done studies on this, and they said, if you have a company and you're a CEO, if you just get listed in the S&P 500, the correlation, your growth will go with the index and start to be less about your company and more about your membership of the index. So you could be doing anything on your company or whatever it is, but it's less important what you do day to day. It's more important that you're in that index, and then you start rising.
Added to that, the algos and the machines are actually following the momentum of all these guys, and that's feeding on itself as well, So that's another factor that, you could cover a full podcast on that. It's an amazing development that has, very significant ramifications. So, yeah, I mean,
they're all kind of blind and following each other.
They are, yeah.
The lights off.
One thing on the sentiment, just this week, a headline came out. It was I wrote it down here. It was on Bloomberg, and I'd never seen a headline like this, but to me, it was like classic sentiment warning indicator, that we're near the top. May not be, but this is just, it is a classic. When you see headlines like this, it's time to sort of reduce allocations. And the headline was, stock market never goes down anymore. This is a headline on Bloomberg. I'm like, the Bloomberg headlines have been getting a little bit more tabloid-like in recent years, and I think they're trying to get bums on seats. But there actually has been a host of those. I actually typed Dow 30,000 into Google News to see what I would come up with, and I came up with Dow 30,000 by year end on Seeking Alpha. Scent of Dow 30,000 on the street. Dow 30,000, how to get there in 2018. And indeed, as we already mentioned, with President Trump talking about that 30,000. So who knows? Big round numbers, they tend to migrate to these numbers. And given the degree of the irrational exuberance and the momentum that's there, it could go higher before it goes lower.
I got to say, I don't know if we have time to talk about, when this might shift and what might be the straw that breaks the camel's back.
Well, one thing that I want to just address, because I know it's going to be on the minds of a lot of people listening to this, because when they're hearing this, particularly about whether it's passive indexes, whether it's algorithmic trading, whether it's the potential of a bubble, they're probably sitting there and thinking, yeah, but I own Apple stocks, I own Google stocks, I own Facebook stocks, I own all the big ones. Surely they're good stocks to continue to hold. They're not going to be affected by what happens.
But they are, and they aren't. This was the argument in 2007, 2008. Some of the stockbrokers and people said, well, these are blue chip shares that will do well no matter what. But all these stocks are massively correlated. And if you get a massive correction or a new bear market in stocks, they will go down as well. And similarly with the US stock market, if the US stock market sees a serious correction or a crash, and the US gets a cold, or the US sneezes, we all get a cold, and the other stock markets will be correlated. They will take lead from the S&P 500.
So the good follows the bad.
It does, and that's not a reason to say that you should sell all your blue chip shares, but potentially you should, if you're overweighted or overallocated some of these blue chip shares, and the tech sector does look quite fraughty, and the FANG stocks have been the sexy thing to own in recent years. So if you do own them and you're overallocated,
the FANG
I wouldn't say sell them all.
Don't know are the
Facebook,
Apple, Netflix, Google.
Yeah.
Right.
And so I think you should possibly take some profits and rebalance your portfolio. I think, and we'll come to that now in terms of, what the real important question here is not whether these markets are on bubbles or not. We think they possibly are, but we don't have a crystal ball and they could become much bubblier. The question for people is what should we be doing in 2018, in the coming years, to protect ourselves from these various risks that we've outlined.
Yeah. Now, when we've seen these corrections or crashes, or even the crisis back in 07, 08, central banks had powers in the form of being able to lower interest rates and move into the quantitative easing that Steve talked about. They also have the ability to cut taxes. Now we've got interest rates near record lows. Some of them have increased slightly, but we're still near record lows. They've got no room left, no firepower left on that. We've seen large tax cuts in the US, and there was a degree of reluctance to push those through. But is there much more room for further tax cuts? So if we're fiscally handcuffed, and from a monetary policy point of view, we're also handcuffed or limited, that really kind of sounds dangerous if we see some sort of correction.
I think this is going to print money. I mean, the quantitative
but
easing.
Can they do that indefinitely? And if they do it indefinitely, what does that do?
QE forever.
Yeah, that massive hyperinflation.
It's a Pandora's box. I mean, you start that process. It's always going to be on the table as a politically expedient option. They're going to go for it. Whenever there's a correction and there's job losses, there's going to be people out for blood on the streets. They're going to force the central banks, even they're supposed to be independent, they're going to force them to buy and monetize.
Print money to finance
print money, exactly, and issue this money, and that's what's going to. And essentially, it'll create currency. It'll create more inequality. It'll create more volatility. It will drive out the fundamentals from the market, and it just becomes an official sector exercise. It's almost socialism, really. At the end of the day, I mean, they're abandoning capitalist fundamentals and market-based economies in favor of stability, because essentially they are micromanaging the markets. I will say one thing: another factor driving up the markets is also the search for yield, the search for return, and traditionally you would have had large sectors of the economy who would have been comfortable with the yield of bonds and fixed income, which were issued on a stable basis. And now, you have bond yields negative in many regards. They're beginning to go up a little bit now. And that is the price of bonds. So if the price of bonds go up, the yield goes down, and vice versa. And so, bonds have been rising in price as people just throw money into them, and they're accepting less and less in return, in fact, negative. And so, some people say, I don't want to lose money on my bond investments or my money I've saved after tax. So they start putting into the stock market, and that's driving up demand for the stocks as well.
And cryptocurrency as well.
So there's a theory that as
people are speculating to get that return,
yeah. So there's a theory that as this wall of money that's being printed begins to come down into the street, inflation is going to rise and interest rates are going to rise as well. And as interest rates rise, there will be less of a reason to own stocks. And suddenly stocks will start looking very, very overvalued and expensive. And if they do start to look expensive, then you have the smart money will start driving out of those stocks very, very fast. That could create a run on the market, and suddenly you have a free fall. And so we've just turned the corner. Suddenly bond interest rates are starting to rise. The 10-year started to rise. It's at 2.5% more now. It's going up again. And you're beginning to have original patterns reassert themselves. And so if that happens, this market looks incredibly expensive.
Another way to look at this, because what we're talking about there is the idea of just printing money. If they start to see a correction that they're
printing currency.
They
can't print money. Gold is money. They're printing fiat currencies. And I said printing money myself. It's funny the language you use, and that's an important distinction.
But when we talk about printing currency, there's a way that I like to look at it, because you say, right, well, if they do print currency, a lot of that money is going to flow back into the stock market, potentially perpetuating this bubble. And you'll have people sitting on the sidelines saying, look at the Dow blowing through 30,000, 35,000, 40,000. And really the way to look at it is, rather than seeing stocks appreciating, effectively what's happening is you're able to buy less stocks for your dollar or your euro. So effectively what you're doing is you're devaluing the currency.
Yeah.
And I suppose to bring it back to what we do here, you have an infinite amount of potential stocks and shares, but you have a finite amount of gold and silver. So in a situation like that, where there is continuous or perpetual printing of money, you'll find that your dollar buys less and less and less gold, or less and less and less silver. The other way of looking at that is the price of silver rises consistently and considerably, and the price of gold rises consistently and considerably.
Yeah, absolutely. You can have potentially infinite currencies, and that's potentially where we're going in terms of, QE to infinity and beyond, or QE forever. There's all sorts of wags who've come up with different titles for it. And that's the real risk. And therefore, if the Dow 30,000, Dow 40,000, Dow 50,000, stocks are a hedge against inflation, so therefore that is likely to happen. People will put money into companies that survive and that will try and generate a profit. And Zimbabwe was the best performing stock market when they had their hyperinflation in whatever year, it was 2010, I think it was. And we have the banknotes. We're in here in the vault room in GoldCore. We have the banknotes up there, which have the Zimbabwean hyperinflation notes up as much as 1 trillion Zimbabwean dollars, and their stock market was the best performing stock market in the world that year. Last year, I think Venezuela was the best performing stock market in the world, and the Venezuelans are in hyperinflation. So stocks are a hedge against inflation, but gold is an even better hedge against inflation, particularly when your fiat currency is being devalued in a massive way, and you get into that hyperinflation scenario. It speaks to the importance of having an allocation to actual physical gold in your portfolio, and given these risks, I think our rule of thumb was always the old rule of thumb was you put 10% of your wealth in gold and you hope to God it doesn't work. But I think today, given these risks, I think it merits higher allocations. If you can put 40% of your portfolio into stocks and 40% into bonds, why wouldn't you potentially put 20, 30, 40% into precious metals? You might put 20, 25% into gold, 5, 10% into silver, and then 2.5% into platinum, palladium, something like that. And I believe in higher allocations of precious metals in this environment, and that might be on the high side, and it wouldn't be for everybody. I mean, you have to look at people and their age profile and their risk appetite, and all these things are very important, and take financial advice. Take financial advice, particularly from financial advisors who understand gold, and advise people to own precious metals, because there's lots of financial advisors who simply don't understand it and don't want to understand it.
Yeah, it's one as you were talking there, Mark, I was just remembering. I've talked to an awful lot of clients recently, and they've been talking about the cashless society and how that's going to underpin a huge demand for gold, because you won't have a form of money that's you can put under your mattress anymore. We'll be all in with the system, and the system is fairly corrupt.
All your eggs in that one basket.
Yeah, and if you think about it, we've talked about this word, this concept of QE, but essentially what quantitative easing is, or the printing of money by central banks, it's actually taxation. It's actually them taxing the money that you have. It's like a percentage on your paycheck. But it's in terms of, it's much more.
It's insidious.
It's insidious. Yeah, it's hidden away. You don't see it. And the interesting thing is the people who are doing this and making these decisions, they're not elected. They're not elected at all. We don't have a conversation, a debate in the media about what the interest rate is going to be or how much, bond buying is going to happen this month. It's just kind of delivered to us on a plate, and we're told to accept it. And we don't see it. We don't feel it right away. But then when we see the stock market rising and we see the house prices going up, and we see the cost of mortgages changing, and we see volatility coming into our economy based on something happening in Europe or America, that's the cost of this. So I think with cash leaving the system or physical cash leaving the system, the actual case for gold as a physical form of money that you can hold out of the system and protect yourself has never been stronger. And it's going to increase. The case is going to get stronger every day.
Yeah, absolutely. The cashless society is, they're trying to corral everybody into this sort of digital economy, and yet every day we hear a new scandal about cyber this, cyber that, hacking here. The most recent one, or even our most fundamental thing, the Intel chips that power most of our computers and our devices are vulnerable in some form of malware. Was it Spectre and Meltdown, or Meltdown Spectre, whatever it was, And Equifax in the US, one of the biggest companies that actually held the data, very sensitive data, particularly of US people in terms of their social security, their payment details, their dates of birth, their addresses. They were hacked. And every month there's a new instance of this, and it's showing the vulnerability of this digital economy and digital finance and digital currencies, and therefore forcing everybody to have all their money and all their wealth in the system is it's not prudent, actually. And you need an ecosystem, and by having that diversified ecosystem, it actually protects companies and individuals. And by corralling us all into this one little system, it increases the systemic risk, because you don't have that diversity and that diversification.
I don't know if we have time to talk about what people can do with a bubble as it's forming, and what and how they should invest, and the toolkit available to investors. Yeah. So I think some of the standard advice we have and we give clients every day, is that you do need to have an allocation to gold and precious metals. And typically, as I said, it could be anywhere from 5% to 20% or more if it's deemed prudent for you and your circumstance. But I think you need to be a little bit skeptical about what's happening out there. You need to be a little bit skeptical about what the media is saying. Take it with a pinch of salt. Ask yourself questions. Is it underpinned? Is it fundamentally based? What you're hearing and reading about. And also then, in terms of your own personal self, you should invest in yourself, invest in your education, invest in your job or your company, or whatever you're doing. Have that specialist expertise about you that makes you very, very valuable as a member of our economy. And that in its own self will help you ride out any kind of extreme volatility in the marketplace. So investing in yourself and your education. You should obviously be diversified in your portfolio, as Mark said. Some bonds, some equities, some real estate as well. Your home, they're all very important. Keep an eye on costs, very, very important in terms of whatever you invest in. You want to be somebody who nickel and dimes. I think it's something that comes very easy to Americans. In Europe, it's something we don't do as much. We're a little bit more accepting, and we should really, really be focusing on costs and getting value for money every time. That's why an awful lot of customers come to GoldCore, because we're extremely good value for money. And you should stay out of cash. Cash is something that people look to in times of crises. It's not always the best place to be, because again, you have inflation, you have the money printers, the tyrannical central bankers who are depreciating our cash and savings. So cash is not necessarily the place to be. Hard assets are probably where you want to be, and then the allocation to them should adjust up and down depending on where you believe we are in the economic cycle. But also read widely, read well, listen to podcasts like ours, and again, go back to the very first point: educate yourself, constantly educate yourself.
Yeah, couldn't agree more. And just the education point is key, because the world is changing so fast, you really have to keep up to date with it, and there's just so much noise out there, and you're just bombarded with all sorts of information. Much of it is disinformation and is disempowering, and it's all about fear. And unfortunately, we have to look at these big scary numbers and the ramifications thereof, but we're not doing it to scare people. We're trying to empower people and then tell people, this is how you protect yourself, and this is how you'll actually protect and grow your wealth and come out the other side. Our mission statement when the company set up 2003 was to protect and grow our clients' wealth, and we've done that fairly well over the years, and that's why we talk about these things. I think education is key. I do agree with everything Stephen said. One thing on cash, I think traditionally financial advisors, wealth management, they would suggest 5-10% allocation to cash. I think in the current climate, given the bubble that's in bonds and the bubbles in stocks, you could have a slightly higher allocation to cash. But the key thing is be aware inflation. It looks like it will take off at some stage. And then with the risk of bail-ins and deposit confiscation, which is something we've covered quite frequently over the years, and a lot of our clients are concerned about that, you need to be very careful about which bank. So looking at the counterparty risk of individual banks, and potentially some of our clients do this, and I see the merits of it increasingly, is take some actual physical cash, a small amount, not a huge amount, obviously, some physical cash out of your bank, put it into a safety deposit box or a vault or someplace safe, a small amount.
Like 3 months. They usually about 3 months of your expenditure that you would have as a family.
Exactly.
You should have in cash.
Yeah, I never thought I'd see myself say that, or say that in the podcast. I mean, I've had a few for 2 or 3 years, but the more I think about it, just given the uncertainty of the world, it makes absolute sense,
So I mean, I think it's been a fascinating conversation in terms of bubbles and where we are with the stock market and what you could do as an investor going forward. One thing is very important for ourselves is that we get as much feedback from clients who might be listening to the podcast. We're always looking for ideas for next months as well. So do feel free to reach out to myself or Mark with your thoughts and suggestions for any future podcasts.
Yeah, we got a little bit of feedback on the last YouTube video, which is great. The podcast is on YouTube, obviously, and whatever way, either send us emails or post comments on YouTube or even on the podcast channels. All feedback is greatly welcomed, and it will very much guide us in terms of what topics we cover.
Great. Okay. Well, gents, that seems like a perfect place to wrap this up for this month. As usual, I've learnt an awful lot from you two yet again. So as we've said before, subscribe to the podcast, the Goldnomics podcast, on iTunes, on YouTube, on SoundCloud. Give us your feedback and your comments, anything that you'd like us to talk about in future episodes. We'd be delighted to hear anything that you have to say. So from me, Dave Russell, Steve, Mark, thank you all very much for listening.
Thanks, guys.
Thank you very much.
You're listening to the Goldnomics podcast with new episodes every month on iTunes and YouTube. Subscribe today to stay informed.